waiting for, and my time was running wild, a million dead-end streets, and every time I thought I got it made, it seemed the taste was not so sweet. So I turned myself to face me, but I've never caught a glimpse how the others must see the faker. I'm much too fast to take that test. Changes. Turn and face the strain. Changes. Don't wanna be a richer man. Changes. Turn and face the strain. Changes. It's gonna have to be a different man. Time may change me, but I can't trace time. Yeah. I watch the ripples change the size, but never leave the stream of warm and permanent sand. So the days float through my eyes, but still the days seem the same. And these children that you spit on as they try to change their worlds are immune to your consultations. They're quite aware of what they're going through. Changes. Turn and face the strain. Changes. Don't tell them to grow up out of it. Changes. Turn and face the strain. Changes. Where the shame you've left is up to her next minute. Time may change me. You can't.
Good day, everyone, and thank you for joining us. We will be starting today's webinar in just a few minutes to allow others the time to join us. Thank you. Good day, everyone, and welcome to this RMA Risk Readiness Briefing. I am Stephen Martin, Director of Business Solutions at RMA. And for over a century, the Risk Management Association has supported members through the most challenging of times, from world wars to financial crises and to the present day in our current COVID-19 pandemic. And one way RMA meets your needs today is through substantive virtual events like this one, allowing members to continue to benefit from RMA thought leadership in a safe and convenient way. Working together, RMA and its members have survived and thrived through historic challenges, and together we're going to do it again. I'm very happy to see everybody on today's call, a lot of familiar faces from our last webinar and some new ones too, so welcome to you. Today's webinar is our second quarter credit trends in commercial lending, presented by Tom Cronin and assisted by Jerry Chalson of AFS. So throughout this, we welcome your questions and your comments. To connect with your peers during the session, please use the chat function. You're familiar with that. Make sure that you're selecting all panelists and attendees. If you have a question for the speaker, you can use the Q&A button and submit your question there, and we'll address as many of those questions as we can towards the end of the presentation. Additional information and tips will be provided during the session through the chat function, so you can pay attention to that. And with that, I'd like to welcome Tom and turn it over to you, Tom.
Thanks, Stephen. And welcome to everyone watching and listening today. We'll be talking about the credit trends in commercial lending, and this is data through the 30th of June. Let's take a quick second to review the first quarter results and then touch on what we're going to discuss today. For first quarter, if you remember last time, past dues were starting to climb while non-accruals were flat. And credit quality, as measured by percent criticized, was declining. Now for 2Q20, the June numbers will show that delinquencies have retreated substantially from their historic April high, but non-accruals, especially CRE, are increasing, and criticized levels are also rising. And other than PPP loans, C&I balances have dropped. CRE's balances are up slightly. So the source of our information, sorry, go back one. Source of our information today is the Risk Analysis Service, or RAS. RMA and AFS have been collecting risk and performance data since the third quarter of 2003. And we are now collecting this data on a monthly basis and have about 700,000 loans and about $1 trillion in exposure. And this webcast will focus on the second quarter results, but we'll mention from time to time the results also for April and May, which were our first two monthly data feeds. And next time out, we'll be comparing July to June. Let me move ahead. There we go. Sorry about that. So first, we're going to discuss the results for the C&I segment. And by way of definition, C&I loans are made for business purposes to public and private companies with sales greater than $1 million. These loans are manually underwritten and risk rated, and owner-occupied real estate-backed loans are included in what we call C&I. Sorry about this. So let's look at loan performance. In April, we saw loans past due 30 to 89 days, the blue line that you see here, reach a service high of 1.23%. Now, as of June 30th, that level has dropped to 0.65%. However, the longer term delinquencies remain at levels that we haven't seen since the recession, and non-accruals, while nowhere near all-time highs, have now bumped up 2 months in a row. So let's further look at the delinquencies, but start with our first poll. So here we were going to ask the question about loans deferred. And if it doesn't come up in a second, we'll just move ahead.
Tom, this is Stephen. I'm seeing it on my screen. The question was, what percent of your commercial loans were deferred due to COVID-19? And I'm guessing others can see it that maybe you can't, Tom. So can I just read off? None had 3%. Less than or between 0 and 5% were 24% of the respondents. 5 to 10% were 32%. And then over 10% of the commercial loans, that came in at 41% of the respondents. Does any of that surprise you, Tom?
Even unfortunately, I didn't hear what you said. Could you try that again?
Yeah, no worries. So the four answers were none at 3%, between 0 and 5%, 24% responded, and then 5 to 10% were 32%, and over 10 was 41%. It looks like we have a little bit of audio and video feed that we're working on with Tom. And while we get that reestablished, I see a question whether we'll get a copy of the slides, and we'll definitely make it available afterwards as we normally do. Okay, Tom, you're back.
Yeah. Okay, so I'll just move on. Sorry about that. So I'll just move on. Sorry about that. So on this two-digit name as of June, highest level in company, we're also are cement manufacturers. At the other end of the delinquency spectrum are 49 transportation and 61 education. As an example, within 49, we're seeing past dues of just 0.01% for couriers and also low levels for warehouses. And next, we'll look at the change in delinquency levels.
Hey, Tom, because you logged off and back in, I now have control of your slides. So just ask me for the next one when you want it. Is this the right slide you want?
Okay, yeah, this slide. Okay, so in this chart, we have selected the 10 largest industries based on outstandings. Then we take days past due percentage for June and subtracted the same measure for March. So if the result is a positive, that means the past due level for that particular industry increased or has gotten worse. Conversely, a negative result is an improvement as the past due amount dropped. The industry with the biggest improvement is 52 finance. Surprisingly, 44 retail showed a slight improvement. Now, 48 transportation at the bottom, which we mentioned on the previous slide, had the largest increase in past due levels. And the increase in 42 wholesale was primarily for stationery and office supplies. So this chart shows the percent of non-accruals for each two-digit NAICS code 63020. And as we commented in the July Commercial Credit Quality Bulletin, non-accruals for 21 oil and gas have surged and are now approaching the levels we saw during the energy crisis in 2017. We continue to see high non-accruals for 11 ag and forestry, and there are a few other pockets of trouble, but nothing as bad as 2111 just yet. Okay, we move slide. Similar to what we did with the past dues, here we're looking at the change in non-accrual levels for the 10 largest NAICS. Can we go back one? Brian, can we go to slide 10, please? Here we go. Apologize. It looks like I'm seeing things a little bit after you guys see it. So similar to what we did with past dues, here we're looking at the change in non-accrual levels for the 10 largest NICs. And again, a good increase is bad. And all but two industry sectors improved, which was the opposite of what we had expected as COVID-19 impacted businesses throughout the country. But what we are hearing from several RAS clients is that we won't know the true impact rules put in place in March and April until the and the federal unemployment benefits possibly expire as well. Okay, we'll move to the next slide. Okay, so before we get too far into talking about loan quality and classified and criticized, let me take a second or two to explain what we do with risk ratings in RAS. When a new bank joins RAS, we work with that bank to map their borrower risk ratings to the RMA 10-point scale. On that scale, loans rated 1 through 6 are pass grades, a 7 is special mention, 8 is substandard, 9 is doubtful, And 8, 9s, and 10s are combined to become classifieds. And when 7s are added to the classified amount, the result is tagged as criticized. For June, the percent classified is now at 2.45%, up slightly from March's rate of 2.07. However, as you can see by the red line, the criticized level has jumped substantially from 5.11% to 6.84%, as banks, unsure of what's to come, placed a large amount of loans into the special mention category. And we found in the past that special mention is actually a temporary holding ground, if you would. So expect these loans will soon either progress to classified or move back to pass. Next slide. Now here we're looking at criticized by industry. And as of June 2020, 21 mining, oil, and gas industry has a criticized rate just shy of 25%, by far the worst rated industry this time. And similar to what we saw with the non-accrual results, 11 ag is also high, along with 48 transportation, 45 retail, 71 arts, and 72 accommodation. I did want to mention the criticized levels for a few subsectors. Within 72, hotels have a criticized percentage of 32.5%. Even worse are department stores at 54.5%, and charter bus lines are now coming in at 59%. Next slide. Once again, we're comparing June versus March for the 10 largest industry sectors. Now, if you remember a few charts back, we examined the change in non-accruals, and all but 2 industries had improved. But here we see all the largest industries have experienced an increase in percent criticized, led by a substantial jump for 48 transportation and significant increases for 52 finance and 72 accommodations. So if you assume that the risk ratings are predictions of what's to come and the non-accruals are indicators of the current status, these last couple of charts are telling us your portfolios are doing fine now, but the outlook is not very good. Next chart. And I believe we had another poll question here.
So Tom, this is Stephen. I'm seeing the poll question, and it says, do you feel your reserve through second quarter is now adequate based on your assessment of the economy, your portfolio, and your borrowers? And I guess we'll just give all of our attendees a few seconds here to look at the answers and answer yes, no, or too many unknowns to be sure. And Tom, while they're doing that, are you seeing the poll question?
I do see the poll question, yep.
Okay. And now the
Okay,
result.
I see it's closed.
Yep.
And honestly, this is what I expected. I thought that too many unknowns at 54%. Yep. I thought that's what it would be. So let's stay with how banks are viewing the future for the next 2 slides. And if you think about it, there are really 3 major unknowns facing banks today. The first is the possible expiration of the federal unemployment benefits and the impact that'll have on their customers. The expiration of the 90 to 180 day loan deferrals that were made in the April-May time period. and the reemergence of the COVID-19 virus in places such as California, Texas, and Florida. On this slide, we show the last 6 quarterly provisions for 18 rather regional large banks, several of which are RAS customers, but not all. And with the exception of First Republic, the provisions for the first quarter 2020 and the second quarter 2020 reflect what we saw on the previous slide with the increase in special mentions. Banks are anticipating significant losses and have doubled, tripled, even increased provisions up to 5 times prior levels. Next slide. And so one more slide regarding the outlook. Here's the allowance for loan and lease losses to total loans for a smaller set of banks. The increases in the allowances for 1Q20 and 2Q20 reflect the uncertainty of what's to come and what might happen as deferrals expire and businesses in states with a surge in COVID-19 are closed again. I really think it was interesting that most of the people in the poll thought that going forward, you might not know if your reserves are adequate and yet not yet, because that seems to be the prevailing case, is that we really don't know what's going to happen going forward. So let's move on to our next slide and look at growth. So here, these 2 charts split the C&I portfolio into 4 size segments, along with CRE and participations. We show 2 columns for each segment, one for the quarter versus quarter change for 2Q19, and another for 2Q20. The chart on the left includes growth for all loans. The chart on the right excludes PPP loans. So if you start with 2Q19 first, we saw very little growth. And what growth there was with the larger loan sizes. For 2Q20, using the left chart, which includes PPP loans, we saw a huge spike in balances at the lower end. Without PPP, the right chart, balances dropped for all segments except CRE. Next chart. So on the next 2 charts, we look at the growth in balances June versus March for the 20 largest 3-digit NAICS subsectors. They are color-coded and ranked left to right by growth rate, high to low, blue being the highest, red being the lowest. This chart includes PPP loans, and the subsectors with the biggest growth were 238 specialty trade contractors and 621 ambulatory health. All of the growth in these 2 sectors were PPP loans, the same with 541 and 722. At the other end in the red, the 2 subsectors that grew the least, or in this case actually had balances shrink, were 221 utilities and 525 funds, which are also 2 of the lowest PPP. And back. So that if we go to page 17, this chart is structured the same as the chart on the previous page, but here we have removed PPP loans, and the result is similar. I'm sorry, go to 18. The result is similar to the chart 2 slides back. Short of PPP loans, growth for 2Q20 was extremely limited to just 3 subsectors out of the 20. And we've been running this chart for over 3 years now, and this is the first time so few subsectors have shown any growth at all. Next chart, please. Now we'll take a look at the commercial real estate results for 2Q20. And just by way of definition again, the loans in this portfolio are usually referred to as investor-owned properties, such as warehouses, apartments, office buildings, etc. Next page. So let's start with examining the performance statistics for the commercial real estate portfolio. A year ago, the past due and non-accrual levels were at or near service level lows. But last quarter, short-term delinquencies had jumped from 0.14 to 0.56. Now in 2Q20, the short-term delinquencies, similar to what happened with C&I, retreated to 0.30, but the 60 to 89 days and 90 plus days past due have almost doubled. And the non-accrual level hasn't been this high since early 2017. Next chart. Here we've pared down the CRE property types to look at just the top 7 property types based on outstandings. And we're looking at the percentage of loans that are 30 to 89 days past due. Industrial properties jumped from 0.11 past due to 0.76. And office delinquencies have also increased to just about the average. Lodging is just below the average. And lodging delinquencies actually dropped this quarter, along with the other property types shown here. But as we'll see on the next slide, for lodging, it's a good news, bad news scenario. Next page. Here's the non-accrual level for each of the top 7 property types for June 2020. And you can see that we have 3 property types that are at or slightly above the averages. So let's start with the levels for lodging, the second column on the left. This is the bad news I alluded to from the previous slide. The percent of loans on non-accrual for lodging jumped from 0.14 to 0.56 this quarter. Multifamily more than doubled from 0.26 to 0.58, and residential is up slightly to just about the overall market average. Office is also up slightly, but along with industrial and mixed use is well below the average. And retail dropped slightly as well. Next slide, please. So this is our last slide. And here we're looking at quarterly growth for the major property types. Overall, CRE was up a little bit less than 1%, and several of these, except mixed use, are well above that average. As we mentioned during the 1Q20 webcast, multifamily has come back into favor and grew at a 4% rate this quarter. The next fastest growing property type is lodging. And as we outlined the increase in non-accruals for lodging and the problems with hotels and all the news about the impact of COVID-19 on travel, frankly, I was surprised to see this. But what I found is that almost all of this increase is for construction purposes and the completion of existing projects, very little new money. And I'd anticipate that as these projects are completed and the hotels are open to guests, that we'll see this number, the increase in outstandings, drop. I'd also point out that retail growth is also strong, but unlike lodging, the growth is in long-term financing. And one last comment, the majority of the growth, regardless of property type, was concentrated in the $10 to $100 million range. Loans below that amount fell or were flat. So that concludes our analysis of the 2Q20 results. And I Apologize for my technical difficulties and look forward to answering your questions. Stephen?
Thank you, Tom. Yep, I'll echo that. I know we had some connection issues, but I think the content and the insights and the charts kind of shown through, Tom. And there were a lot of questions about whether or not we could get these slides out. So I just want to assure all of our attendees that after today's presentations out, we'll get an email out to you so you can get the slides and look at them directly. And you can also ask questions right now. This is the perfect time for it. I see a couple questions queuing up. And in the meantime, I wanted to just remind people that the risk analysis database comes from now monthly loan file coming from a bunch of banks that are contributing to this all across the country. And this is the perfect time, I think, during a credit crisis to be looking at this kind of data. And I think and trust that it's helpful for you as you're trying to make sense of your own portfolios and looking at the trends. And Tom, a lot of your comments today, I think, spoke to the macro trends, and I'm sure it's going to spur some questions now and afterwards as well. Okay, so I'm looking at the questions right now, and I'll just start from the top. What's the forward look, in your opinion, based on the current data? That's a pretty broad question, Tom.
So I guess if the question is, what do we think is going to happen? I think if you go, remember the chart we showed where the provisions are, 2 to 3 to 4 times as high as where they were.
Right.
I think that's what you can sort of expect, somewhere in that range that non-accruals are going to be headed, particularly as the deferrals end, and if it looks like a lot of the states are having to pause the reopening or go backwards. I think that those predictions that the banks have made of 2 to 3, 4 times the losses, I think, are probably going to be accurate.
Yeah, and I think a related one, I see another question on when it all kind of melts down. And like you said, it's a little bit dependent on those deferrals and forbearance, a bit of the paycheck protection stuff as that wears off. And as the various states and regions choose to crank back their opening for businesses and so forth. That's certainly going to have a chilling effect on commercial real estate and many other, the hospitality, travel, those types of things. Okay, here's another question. Are there any new or different macroeconomic factors that should be added to portfolio monitoring as early warning key risk indicators as a result of the pandemic?
So is Jeremy on? Jeremy, can you unmute and talk about the work that you've done?
Sure. Can you hear me okay?
Yeah.
Great. So in the past, I think the work or the indicators that we used to look at were the unemployment rate and GDP. Those two had historically a really strong correlation between commercial loan delinquencies and non-accruals and some other key risk indicators in the data set. I think right now it's a little bit harder to figure out because things are moving so quickly. What are the new indicators? I'd say anything that can measure liquidity is a good place to start. If you can get some detail on unemployment rates at the city or state level, looking at it geographically is also, I think, really helpful, trying to figure out, for example, if there's some cities or states like New York or Texas that are really getting it hard by the pandemic, trying to get some real-time data on employment trends there, on payroll trends, anything like that can give you some insight into where delinquencies and non-accruals might be headed over the next few months.
Yeah, terrific, Jeremy. Thank you. Okay, I've got another question here that I don't know that we'll be able to directly answer here on the fly. It's Anonymous says, this is great info. How do we get similar data specific to the region that we're doing business? And I might just make a plug. I see we've got our contact details here on the page, but the risk analysis service is a subscription service that's been available, to everybody. We're actually making it, I think, easier for people to subscribe and use. So that's definitely one thought on it. And before I kind of move on to the next question, Jeremy or Tom, is there any other kind of regional splits or slices of the data that we ever produce as part of information like this for the members and others?
So from time to time, we will, in the previous webcasts, we have gone down to either the regional, state, or CBSA level. And that data is all available. For this presentation today, we stayed away from dropping down any additional levels just from a time standpoint.
Yep, okay.
But as you mentioned, if somebody contacts us, we can give them additional information.
Yep, terrific. Thanks, Tom. All right, this next question, I don't know that we'll be able to answer directly, but the question came in as, what is the percentage of criticized loans that is acceptable per the regulators? And I know that, just being on top of your portfolio is going to be very important to all of the examiners. But Tom or Jeremy, do you want to take a stab at that? Maybe not.
Yeah, it's a great question. I'm not sure from a regulator's perspective what they would consider to be reasonable right now. Obviously, I think there's a little bit more leeway since all the banks are reporting higher criticized right now. The market's really turning. I think it depends too by industry sector. You're certainly going to see more for the energy industry and the hospitality industry right now. We work with a few banks that have been pretty proactive and cautious about, I think Tom said, moving some loans to special mention, at least temporarily, until things become a little bit more clear with the economy. But yeah, in terms of how the regulators would view an acceptable level, I'd have to do a little bit more research on that and get back to you.
Thanks, Jeremy. Next question, do you feel that there is a disconnect between the dire macroeconomic data and a relatively well-contained impact on loan delinquencies? If yes, how do you explain it?
So this is an interesting question. So what we think has happened are a couple of things here. First of all, the amount of loan deferrals we think has masked some of the problems that are out there with banks. We think, that with delinquencies being in like 0.5 range, if your banks had done deferrals in the 5% range, that the actual delinquency rate, pardon me, is somewhere between there, the 0.5 and 5. The other thing that I think is going on is that what we found after the recession is a lot of banks, some of them using RAS and some of them using other things, actually de-risked, what I'd call de-risked a lot of their portfolio. We saw, and if you've been following the webcast at all, you saw a tendency to shy away from the smaller loans, which naturally have a higher delinquency level. And they've also shied away from various industries. You might have seen, or you might recall, the 10 largest industries, oil and gas was not in there this time. Oil and gas was a large industry for the most banks a few years back.
Yep.
And I think that's also happened. The banks, we've heard of a lot of banks de-risking their portfolio, being careful what they've done. Like for instance, in loan to values on CRE, they've stuck pretty well to staying 70% or below. So we think it's a combination of the deferrals and the de-risking of the portfolios.
Yeah, good. Okay, terrific. Keep the questions coming, folks. We've got, plenty of time to answer them. Next question, are you hearing from banks that their regulatory agencies are increasing the criticism of their portfolios, or are they being fairly muted still?
So I have not heard of the regulatory agencies saying anything just yet.
Yeah, nor have I, Tom. I know that a lot of the focus earlier in the year was on the energy portfolio. So I think when prices briefly turned negative, along with all the headwinds we had from COVID, I think there was definitely a lot more scrutiny of banks that had large energy concentrations. Beyond that particular sector, I have not heard of any increased criticism, at least not yet.
We'll have to kind of monitor that. I know that everybody's interested in that question.
Right.
Here's an interesting question. Where would you see the growth from a lending perspective, if at all? And it reminds me of some recent news about winners and losers in the COVID economy. And while we do focus on things like this in terms of like who's heading down, what's contributing to non-accruals, there is another side to the story, isn't there? There's things like Zoom, and there's other industries that are actually getting a lot more attention and clicks and so forth.
Yeah.
So guys, are you seeing growth from the data or from your conversations in any other subsector?
There is one that I've gotten a few questions about from some of the banks we work with, and it wasn't a huge concentration just yet, but even before COVID-19, biotech was a subsector that a lot of banks we worked with were asking about, seeing if there's any growth there. What are the credit characteristics? I think given all the research that's being done right now in terms of vaccines and studying the virus, it may accelerate some of the trends that we're seeing in the biotech industry, specifically some of the growth in that sector. So anything that could, as Stephen said, actually prosper in this environment might be an opportunity for loan growth, and that would include biotech and a few other sectors. Unfortunately, there's probably more sectors right now that are hurt than that are benefiting from the current scenario, but certainly biotech and maybe a few other niche lending sectors could see some growth in the coming months.
Yeah, and that'd be something, Jeremy, that we could probably see in the RAS database as those new accounts come in.
Absolutely. You would see that real time as the new accounts came in. So if other banks are beginning to see, hey, maybe there's an opportunity here to grow biotech lending, or maybe this area of the country that hasn't been hit quite as hard by COVID is growing. You could also look at it geographically. I mean, obviously there's cities like New York and Chicago that have been hit really hard, but maybe some areas where the virus is relatively contained, or where the stay-at-home orders aren't quite as strict and businesses are prospering. Those could be areas of growth over the next few months. And as Stephen said, in our data set, you would see that happen as the new accounts came in.
Thanks, Jeremy. This is a broader question just on the risk analysis service database. And the question says, how statistically valid are your outcomes to the broader US banking universe? And what % of the loan universe do you believe that we're surveying through this?
So this is a hard number to get a handle on, but what we have found, or what we think we found over the years, is that we have about 50%, maybe 60% of what I would call middle market lending. And so that would be a statistical number that I think would have a lot of validity. The large corporate loans tend to be more bonds, and we don't have a lot of that. And the smaller business banking loans, we have a significant portion there, but not as much as we have with what we call the true middle market. So loans to companies with sales, say between 20 and 200, 300 million.
Yeah.
So that's really our sweet spot.
And one thing I'd add too, Tom, is as part of our QA, we cross-check some of the high-level trends with things like the Fed H8, which has some loan growth, not broken out by industry, but they have it for C&I loans and CRE. The FDIC at a very high level will release non-accrual trends. We track those government sources very, very closely. So the advantage of this data is we can break it down by industry and geography, but our overall growth trends and our overall performance trends correlate very strongly with what the Fed's reporting. So we definitely feel it's a statistically relevant and valid source of data.
Yeah, I would agree with that. Okay, a different question, guys. I know that you track all sorts of other macro things. This question is just about whether you're seeing any trending information on bankruptcies.
Yeah, I don't have anything on that, Stephen. I apologize.
Yeah, no worries.
Yeah.
That's something we can layer in for the next time we do this call. Here's a fun one. I think we could all ask ourselves this question. What keeps us awake at night?
So I assume he means not my dog. And so to be honest, when I saw this, to tell you, to be honest, I'll give you sort of what we've been doing at AFS. We all went home or start working at home in the middle of March. And we thought we were coming back in July, actually in June. And then it was pushed to July, and now it's been pushed to September. And I'm just wondering how much further it gets pushed. And if you think about it, of some of the industries here we said that are having problems, anything related to commuting or people working in an office, restaurants, bus lines, office stationery supply, and all those things that we sort of take for granted. I think as long as this continues, you're going to see really hard times for those type of industries.
Yeah, I would agree, Tom. I think, it's almost hard to separate the news on things like cases and hotspots across the country and openings from what we would normally see in our portfolios when it comes to a crisis like this. And until we can kind of see some good news and some good trends on that, I think that there's a worry for those industries that have already been hit hard. Another question, is there anything that we're missing? I'm not sure if I fully understand this, industry and or the regulators. I guess we as an industry or the regulators are missing. That might be a hard one to answer.
I think one of the hardest parts is trying to figure out, and there was an earlier question about, what variables should we be looking at to predict where the market's heading, both the loan market and the broader economy. And it's so hard right now to get real-time data on not only the cases, but on unemployment rates, on payrolls. I think unless we could really get a model that would incorporate some real-time statistics, it's going to be very, very difficult to understand what the credit outlook is for the next few months. Again, there is some stuff after the fact. You can get some data, for different cities and states, a month later. But without those real-time indicators, I think that's what we're missing in terms of trying to forecast just how bad this is going to get and how long it's going to last.
Thanks, Jeremy. Just a follow-up comment for the group, a reminder that exams of the Q2 results won't take place until Q3. And so we're just getting those call reports filed. So we'll probably talk about that in the coming sessions over time. Okay, next question. Do you expect the regulatory agencies to push for banks to reflect best estimate in loan ratings and ALLL by the end of the year, 12/31? They have allowed some time, but is it likely they need to set a deadline? So here's the crystal ball thing again. Hard to know.
And I think, I'm not sure if his name is on here as a contact. Is Doug Skinner's name?
Yeah.
If whoever has asked that question, I see it's anonymous. If you would address that to Doug Skinner on this list, I think Doug might be able to have more insight into that question. Okay.
Do you guys get any feedback from accountants? Are they, what is their attitude right now? And I'm not sure if I understand this part, but are the firms consistent in their approaches? I'm personally not getting input yet from the accounting industry and how they're treating things like forbearance and paycheck protection things, but I'm sure they're figuring that out with their relative businesses.
Yeah, that's a good question. Exactly what you said, Stephen. I'm not sure at this time. I'm sure there's a lot of work being done right now around that question, but no, at this time, I'm not sure how some of those accounting firms are approaching that particular question.
Okay, let's move on then. Any insights to the residential real estate market, be it repurchase or a new build?
So what we're seeing in the statistics on CRE is that 2-3 years ago, the residential real estate market was hot as could be with low rates, and the economy was doing well. So houses were being built and purchased, things just weren't staying on the market much at all. But now with all the uncertainty, it's sort of ground to a halt for most of the banks and most of the market. We do see occasionally one or two banks are taking advantage of this, but this is pretty much ground to a halt, and the multifamily has taken over.
Yeah. Good. All right. Another question coming in from a risk standpoint. Are you seeing lenders downgrade segments on the portfolio based on a NAICS code? For example, all hotels in a portfolio immediately get set to watch.
Yeah, and we saw this 4 years ago, I guess it was, with the oil and gas,
Right.
where anything that was oil and gas service or exploration, automatic, it never was in past due. It just went right to non-accrual, right to watch, until they could figure out what was going on. So I was sure with the big jump in hotels that we talked about, that's what's happening. I imagine you're going to see the same thing for some of the other industries like restaurants. So I think there is a lot of automatic placing of industries that have, the impact of the COVID closures is very obvious, and I think they're just putting them right into watch or special mention.
Yep. Yep, that's good. All right. Keep the questions coming. We've got just a few more minutes, folks. Appreciate it very much. Here's a question just in that crystal ball category again. If a vaccine can be developed by year end 2020 or first quarter 2021, how would that compare to expectations if it goes beyond that? And that really probably speaks to, the stresses that those industries are under right now and their survivability, probably whatever kind of protections or aid that they can get through government programs or if they can reinvent for example, dining in with takeout and that kind of thing. But guys, do you have any crystal ball predictions on that?
I do not, Stephen.
Yeah, Stephen, I'm sure that would definitely increase our optimism and the outlook. But I think just as importantly, what you said, are these programs designed to help people and businesses, whether it's the PPP program, whether it's forbearance, whether it's any type of assistance, is that going to be renewed or extended as the crisis continues? And I think equally as important, I know the area that we live in here outside of Philadelphia, it's not too bad in terms of some of the restrictions and a lot of businesses are able to operate. But if we go back to lockdowns, if we have more restrictions, if states roll back some of their restrictions that they loosened up in recent months, that's going to have a really big impact. So it's just how much it's the government programs combined with, how much can the economies continue to stay open. I think those two factors are really going to determine not just the vaccine, but those are factors that are going to determine, how well businesses can thrive over the next few months.
Right. To keep an eye on all sorts of things, don't we?
Right.
Okay. Next question, back to the RAS database. Guys, are you familiar with any banks using the data as input to CECL modeling?
So we do know that some banks are using the RAS historical data, looking at how certain industries performed over time versus during the 2008 recession, to kind of get a feel for how an industry sector would perform with us in the CECL viewpoint.
Great.
Yeah, another thing with CECL too, I think a big component of that is trying to group the loans into different pools and assigning different loss rates for loans that share or exhibit unique characteristics. And so one of the things we can do in RAS is we have data going back all the way to 2003. So we can see how different industries or different product types performed during the last crisis. And it's been allowing some banks to figure out, well, from a CECL standpoint, what should those pools be? How should we aggregate and disaggregate the portfolio? So yeah, trying to figure out how you would go about segmenting the portfolio and what loss rates you assign to those different segments. RAS can definitely let insight into that component of CECL modeling.
Yeah, great. Okay, now back to our kind of look at macro and other factors. Here's a question about the pending eviction crisis. So there's been a lot of talk about putting a pause on evictions. I think that may be state by state, but also part of the CARES Act and paycheck protection type of things. Some of that, or maybe all of that, is coming to a close. I know that Congress is working on new legislation, new support. I don't know if it includes keeping people in their homes. But the question is, I've seen up to 50% in some regions are facing evictions. Does the RMA, and I think they mean RMA and AFS, have any information on possible percent of people facing evictions and the impact that it may have on multifamily sectors? And I am not aware of particular percentage numbers other than what we can see in the news. But Jeremy or Tom, what are you guys seeing?
Stephen, I don't have any specifics on this. I
Yeah.
think this might be something we'd take back and take a look at.
Okay. Well, we're just getting to the top of the hour, and I don't want to keep people. Maybe we've got time for this one last question. As credit ratings for corporate and sovereign debt continue to decline, what alternative stores of value do you think consumers will be seeking if they are unable to obtain credit due to tightened standards? It's a little bit outside our normal questioning, isn't it?
Yeah, good question. I know that before the crisis, we did see a lot of growth in terms of non-bank intermediaries and non-bank depository institutions, and they were filling a void in the smaller end of the commercial space. So borrowers that may have been passed over by commercial banks were seeking alternative financing from these other intermediaries. Funnily enough, a lot of these non-bank depository institutions were actually taking funding from commercial banks. So it's all a very complex related web.
Yeah.
I think right now liquidity is drying up across the market. So I'm really not sure if people and businesses can't obtain funding through their traditional lender. I'm not sure where they're going to find it. It's certainly a very difficult environment right now to get credit.
That's great. Okay, guys and participants, we're at about 57 minutes after the hour, and that's probably a good time for us to wrap up. We didn't get to absolutely everything, but we'll reach out to people that ask questions that we didn't get to. So I want to say a big thank you to everybody who attended and stuck with us through it. Be sure to be on the lookout for our next webinar on the RAS piece. I want to say a particular thank you to Tom and Jeremy and the whole team at AFS. As always, great partners on this, great information. You've got our contact details if you'd like to kind of reach out. On the RMA side, be on the lookout for our next risk readiness seminar, and that's in August on consumer risk, and I encourage you to take a look at that. That'll be useful as well. And from all of us, again, a big thank you, and with that, we'll close today's webinar.
Thank you, everyone.
Heart is a blow, shoots up through the stone